And what's going on, YouTube? This is Dan French. This is the Sound Off. And what's going on, folks? Let's get right into it. I want to talk a lot about what's happening in the markets. You guys know I'm a real estate agent out here in Las Vegas. So if you guys need some support, help, I want you guys to come here and register here. This is LV Home Professionals. Great place to get started if you're trying to buy a home. And I have a lot of people registering. People are listing their home, getting ideas because you can go in here and list. Get a map of what's going on. So again, that's a great place to get started. I'm going to talk today about what's happening with the psychological impact people are having on their the mindset really of buying into a home and the home affordability problem we have in Las Vegas. We came out as like number 3. So a lot of people are still out there really looking at, okay, is now a good time to buy? Should I, wait 30, 60 days? Everybody thinks that this market's going to crash. A lot of things on unemployment. So today we're going to talk about a lot of people with problems in buying a home, some of the things that they see on the data and the media and information that's being put out. And then I'm going to give you my opinion on what I see is going to happen here in Las Vegas, and also with rates and payment in the next 30, 60 days. We don't have a crystal ball out here as far as real estate agents go. Myself, if we did, we wouldn't be doing this job, right? So that's one of those things. So we're just going to give you our best opinion and our best analogy of some of the data that I see and the psychological effect and the mindset I'm working with on people listing and also helping people buy homes in this market. So the first thing I want to bring up is let's go ahead and look at the mortgage rates. Okay, so people always say, well, what affects mortgage rates? Mortgage rates have an inverse relationship. As the bond price, you have 4.5% coupon. It's mortgage-backed securities packaged up and sold. And these are sold to investors. As those yields go up or down, that really determines in a lot of ways what mortgage rates do. We hit on the 10-year yield, which is an indicator of what really rates may do or not do. We were at like 2.94%, and we really went up recently on that yield. Now it's come down a little bit, but people use that as a barometer to find out. But if you look at this volatility, right, this is what the markets are doing. Volatility, 30-year fixed, you go all the way back to Thursday, February 17th, back at the beginning of the year. Man, it really started to increase right here. Okay, you could see week ending Thursday all the way up to, all the way to May. Now you're in June. You could see how it goes up, comes down, pops back up. That just tells you that there's a lot of uncertainty in the market, uncertainty with mortgage rates right now. And investors are really having a hard time investing on mortgage rates. A lot of investors are just buying cash here in Las Vegas, and I think that's where the unfair advantage is. And also, that's really the competition that you have for home buyers, not just primary home buyers, investment, and secondary homes. We're going to talk about secondary and investment properties, and is it a good time to buy that as well using a loan. If you're going to buy cash, hey, cash is king, right? So let's go back and look at this. What does this mean? It means 5.54%. It would cost you almost a point to get the rate. That means that's not the rate you would get. That you're probably closer to 6%, and they have that at what's called par. So that means it's going to cost you, if you have a $500,000 loan amount, that's going to cost you $5,000 to buy the rate down or close to it, 0.8, right? So that's almost a point. Same thing if you go back, you can see that for your 15-year, it's at the high 4s, and for a 5/1 ARM, which a lot of people are starting to look at ARMs because of how they're pricing out better. A lot of people are looking towards the ARM position because they don't want to be shocked, right? They don't want payment shock. So when you look at rates and you look at what's happening with people and really on the fence if they should buy or not, rates are still lower than the inflation numbers, which is really, it doesn't happen a lot. Inflation's like 9%, and we're at mid, I would say mid to high, 5s if you're not buying the rate down. So, I had somebody recently tell me how much it cost to buy a rate down just to get it into the high 4s. And it was an astonishing number because the margins that are there with these lenders, it's just not there. They're going to lose money. So let's go back, and I want to talk a little bit about where we're at with just overall unemployment. And, unemployment, for every unemployment or unemployed person out there, there's 2 jobs available. Now, we've seen in the last 3 weeks, and I want to bring this up, as far as the last 3 weeks of decline or people getting laid off or just jobs that people are leaving or getting fired or whatever it is, these people, you're seeing an uptick in the amount of unemployment. It's not high numbers. I mean, we're still at a very low unemployment, but you could look at this sector here. Every sector that's really gauged or monitored, you're looking at government jobs are the only jobs that we lost in the month of June, which is very good. I mean, you look at all this information and you're like, well, man, the economy's doing well. It is, but again, they're struggling with inflation. They're struggling with how do they keep this thing and tame inflation and bring it down to that 2%. Now the numbers are coming out that the inflation is going to take longer to correct. The Fed's fund rate will be increased 75 basis points. They're going to have the Fed's meeting coming up here, and it's been all talk or no talk. It's been all quiet for that, for this coming up. All speculation is they're going to raise the Fed's fund rate. What it affects is short-term bonds, right? Or student loans, car loans, credit cards, those things that people use. A lot of people use, not on a daily basis, but these short-term loans or bonds that they get that are sold, right? So that affects your purchasing power. Now, what they're trying to do is slow the economy down. We've seen it 9%. I think it's higher than 9%, but they're trying to get by 2024, get it back down to the 2% range of where they want it to be. Now, I want to bring up this too, is that when you look at people that are working right now, they have an age group as far as, I think it's like in the 20s, low 20s, all the way up to like age 54. There's high numbers of people going back into the workforce. So there is a lot of people that want to work, but you're still seeing, for me, everybody always talks about, well, what's going to happen? Are we in a recession? Is this going to take place? I think there's going to be a housing correction where we're going to come down a bit. I don't think there's going to be a full recession. Now, one of the last indicators, though, that you want to pay attention to is what happens with unemployment. Because if unemployment numbers really spike up and we start getting close to double-digit unemployment, that's a real big alarm right there. A lot of other things that's happened. Builders right now, they've been suppressed. They're not getting the same business. The material costs and things like that, surveys and a lot of data coming out with the rates higher and still the material costs, that they can't really get that margin they were getting. The lot premium or it's the lot fee because you're paying for the land. Lot premium would be, if you're looking at the strip view or you're just looking at a specific view, or maybe you're buying in a cul-de-sac or there's something different about that lot, they're going to add a premium. But these builders are also suffering with these higher rates, as you can see. Now, I also want to bring up and come over here. Let's look at let's kind of segue over to another topic here. I want to bring up existing home sales. Now, good old Fred, right? Our friend Fred, economic data. Now, this is for the country. You can see that this is home sales, housing inventory, and we've been increasing. We're on a nice flow all the way to our current month. We're at 1,260,000 homes across the country of inventory, housing inventory. That is also another thing with builders don't want. They don't want high rates and really a lot of inventory. Now, here in Las Vegas might be the outlier because we haven't seen an uptick in mortgage rates. I'm sorry, not in mortgage rates, but an uptick in buyers for builders, because with the inventory as high as it is, people are still paying on existing homes. They're still paying the numbers we see across the board all the way up until about 800,000. Once you get to 800,000, now you see where you're getting offers taken below list. But for across the board, you're getting at list. And even in some instances, you have cash coming in and just, taking over, especially in that $400,000 to $600,000 range. But let's go back. So we have this indicator here with Fred. Now, I also want to bring up this, which is, let's look at the numbers, right? And the numbers always tell us. So this is all properties that have come on the market, and we're in the month of June here. So here in Las Vegas, we have 8,968 homes on the market. Look at this uptick, right? This is a huge swing, and it's almost going straight up. Now, what's ironic about it is you still have days on the market, only 8 days, okay? Our month's supply, look at this, is also at 2.2 months. That's good, right? This is all great indications. And so when you look at these numbers here in Las Vegas, the only thing that's holding us back really is that we have higher rates. The demand is still there, but I think it's really pushing a lot of those primary homeowners and people on the sidelines because you have inflation, you have all these factors going on, and there's a lot of things that people are struggling with. And one of them is to buy into a house. If you look at renting versus buying into a home, it's very comparable what rents are versus buying into a house as far as the mortgage payment or what that will be. So I think it's easier for some, but a lot of people just don't trust the market. They think that this thing's going to crash. They think it's going to decline. And we're going to see a decline, right, in homes. But overall, I'm just looking at these numbers, and it's really strong numbers as far as the inventory increase that we've seen. Now, I want to go back and look at this other data here. So a lot of the data that we see is, you have initial jobless claims, and you have a lot of economic reports that's going to come out next week, and this is going to indicate. So you have gross domestic product, right, that's going to come out. They're saying it's going to be an estimate of 0.9. Really, it came in at minus 1.6. All of these are high. The Fed's meeting has high in impact. What does this mean? It means that there's a high, not probability, but there's a high, I would say, case for if these things come in at different numbers or maybe lower than expected. What a lot of investors do is they take their money out of the bond market. They put it into the bond market, take it out of the stock market or riskier assets, put it into more safe havens like the bond market and treasury. So I think what's going to happen here is I think that we're going to see a huge increase in the Fed's fund rate's going to raise these rates, right, the 75 basis points. Then we're going to start to see the economy retract more, and people are really going to start to see that the economy is slowing down because really what they're just really trying to pump the brakes on this thing. I don't feel like this market, we're not technically in a buyer's market. We're heading that direction. But it's a very interesting time to buy a house because I think there's a lot of consumer confidence that people are not confident, right? A lot of things that people do are all confident on the economy, the markets, everything else. They're not confident, I guess, when you look at rates. Some people, hey, you know what? If you're going to buy, you're going to buy. But for me, I look at the psychological effect it's having on people, and it's not me talking into them, but we have to really weigh out the pros and cons now. Before, it was like whatever you want to get, if you want to go above list, this is the perfect time. Dude, people's mindset were like, hey, I'm all in. I'm going all in. I'm buying, whatever it is. With those higher rates, it's really changed people's mindset about what they think about this market and really can they afford buying into a house altogether. So this is it, guys. I just want to give you guys a quick update on what I see out there on unemployment, the interest rates, the numbers overall, and also inventory, and where I see the markets heading. I think in the next 30 to 60 days, it's going to be a very interesting tale of what's going to happen. It's really going to tell us what's going to really be, how the market's going to really flow towards the end of the year, heading into 2023. If you guys check out LV Home Professionals, please subscribe to my channel there, subscribe here. If you guys have any questions, all the comments in the comment section. I'll have all the links. We're going to have landing pages, everything in these comment sections, and we'll see you guys at the next one.